Hello everyone and welcome to this week's live FX webinar. My name is Craig Erlam, Senior Market Analyst at OANDA. Thank you as ever for joining. I hope you've all had a lovely weekend and that you're looking forward to a hopefully fantastic week to come. In terms of what kind of week we're looking at, it's a bit of a weird one, I must say. It's in many ways there's plenty going on, and I don't think you need to look much further than the markets to see that. In terms of the economic calendar, it's looking a little bit lighter, but there are some really key notable points which we will touch on today. We'll touch on some of the more macro developments as we go on as well. Again, the markets are moving because things are developing. So we're still very much in a movement mode, which is obviously fantastic for anyone who likes and wants to see market volatility. Hopefully you should all be able to see my screen right now. We'll be looking at the OANDA MarketPulse website, where myself and my colleagues post all of our content on a daily basis. It's also where you'll find the recording for this webinar later, as well as on YouTube and my Twitter page, LinkedIn, anything like that. We'll post it in as many places as we can. It's also where you'll get access to the economic calendar just up here. And just prior to this, I did set up the calendar with all of the things that I review as relevant for this webinar and for the currency pairs which we are hoping to cover. If there is any additional pairs, or if there is any additional additional FX pairs which you want me to take a look at, even if it's things which I've not looked at previously, please do just ask. I want these sessions to be as interactive as possible, so questions are always welcome, and we'll try and rattle through as much as we possibly can. As ever, there's always lots to cover, so if I do run a little bit over, then apologies. But like I say, I want people to get as much from this session as they possibly can in these kind of live scenarios. So if there is anything, then please do not hesitate to ask. In terms of what's on the event on the calendar this week, there's a lot of UK and China focus mainly, if I'm perfectly honest, and you can actually see that straight from the beginning of the week. So I've just highlighted medium and high tier events here. You'll occasionally see a couple missed off that fall under the low tier bracket. So apologies for that. I just didn't want to clutter the page with items which we're not going to be particularly interested in, maybe creating a bit of a distraction from some of the more important economic releases. So things like API crude inventories are typically a low tier release, whereas in reality, that's very much not the case. Maybe it's just a bit of a lagging thing on some of these calendars. In terms of what we've seen already, so again, some very interesting data. Your Chinese trade surplus still running extremely high. The interesting thing here is the cost of a trade war with the US is being felt both in imports and on exports. So that while the trade balance is still high, the overall trade numbers are really taking a hit. It was the exports which surprised on this month, actually registering a small increase versus expectations of a decrease. I do still think we're seeing in many ways the impact of the tariffs which have already been imposed, and by which I mean when companies were aware that tariffs were coming, we did see there was plenty of evidence of them front-loading their imports or front-loading their exports in order to avoid having to pay these tariffs. And you can see these in the spikes in data, for example, that we saw early on last year, and you can see it again on the imports numbers as well. Clear signs that this front-loading was happening. Now, the problem that we have here was when we see the evidence of this kind of front-loading, and therefore you're seeing things like 25, 26, 27% year-on-year increases in your import data and export data as well to an extent, is that it's got to have a knock-on effect at some point. You can't continue to import at these levels. The idea being that you can buy months in advance, which means you don't have to buy months after. So that's why we've taken such a serious hit in the import and export data. In terms of who is worse off at this point, it's very difficult to say in many aspects. I think it's quite clear that it's taken its toll on both economies, and that was always likely to be the case. The message is that China has more to lose because it runs a deficit, and in the longer term that may very well be the case. And we've seen, for example, Chinese stock market's been an awful lot more volatile in response to the prospect of a trade war. It's managed to buffer itself to an extent so far through currency depreciations, although a lot of that, to an extent, is free market. It is the markets moving in response to the tariffs themselves, but also fiscal stimulus, monetary stimulus, as well as enabled the country to shelter itself from much of the pain, and also its ability to quickly restrict imports of US goods in order to really deal its blow to the best of its ability to the US. The US, of course, is also we have seen growth and other data take a bit of a hit. We've seen a dramatic shift in expectations for the central bank as a result of what we're seeing in the economic data. We've seen a lot of pressure from both the Trump administration, but also from the markets now on the Federal Reserve to start cutting interest rates. And we can see that now reflected very much in the interest rate expectations. It seems that they are declining almost on a weekly basis at this point. And now, I mean, we can look at the June meeting, and it seems that markets are very much not buying into the prospect of a rate cut quite yet. That's the meeting now in just over a week's time. Of course, the Fed is in its blackout period. It never makes public appearances and speaks in public from the beginning of the week prior to the Fed meeting. So that will be Monday with regards to this week. Just so you're aware, this is a CME Group Fed Watch tool, which gives interest rate probabilities based on futures pricing. You can also use other tools as well. There's Reuters, there's Bloomberg. There are other options available here. This is just a quick and easy one to find. But I'm not necessarily interested in June so much. The reason why I think markets are not as interested in June, if I'm honest, is because so much really hangs on this US-China trade deal. And with the G20 taking place at the end of this month, which is after the Fed meeting, I think traders are possibly looking at that June as being a little early, and that the outcome in terms of actual interest rate cuts will be highly influenced by those discussions. So I think they're looking at that June meeting and they think the Fed would rather hold off, see what the outcome of that is, and then make the judgment from then on in. And the unusual thing about that is it's over the past decade, all the major decisions, I'm pretty sure, have come in either March, June, September, or December, simply because that's when the Fed releases its new fresh economic forecasts, and therefore it better enables them to justify a shift in monetary policy when new forecasts are made available. But I think this has been shifted by the fact that we do have that G20 meeting later on this month. The interesting thing is what we're expecting come the end of December, because this is only 6 months away at this point. And I find the expectations for interest rates quite staggering based upon that. If you look at this, this is the current rate at 225 to 250, and markets see a 0% chance of a hike and only a 3% chance of this being unchanged. What I find to be the most interesting thing here is this has shifted over the last day, well, over the last week or two, really. We've been bouncing in between. But markets are effectively saying that they think there's a 50-50 chance that we'll see 3 rate cuts or 2 rate cuts. I find that quite amazing, because that is a lot of rate cuts in a very short period of time, which means the Fed will either have to cut in July, September, maybe December, or we're going to have to see a 50 basis point rate cut, which seems extreme given the current circumstances. And what I mean by current circumstances is, if you take a look at the chart, which I'm about to chuck up now, so this is a few simple charts from Reuters Icon, which I just pulled off for you. And there's obviously a lot of concern right now that the economy is going through a difficult period. And I think it's safe to say that what we can see here is there has been a bit of a slowdown. That's unquestionable. You look at retail sales down here. This is the average. I think it's like a 6-month rolling average of retail sales in the US, just to take out some of the noise that you can see in the data there. And of course, there has been a slowdown since late 2018. But we have to remember that there has been the fiscal stimulus, which we saw from the tax cuts, was implemented right at the end of 2017. So the biggest impact was always going to be seen throughout the year of 2018. And you add to that the bit of a slowdown we've seen in the economy, and that would explain a large portion of that. And it's not exactly too dramatic here. We've just seen this fall off a little bit, and we've seen it plateau since. We look at the jobs data. Again, I'm not seeing too much to worry about. Of course, we have seen a bit of a decline since the start of the year, so we have lost some of that momentum. But again, how much of that is due to the end of the fact that we are a year into that fiscal stimulus now, and we do have to see some fading. And I'm looking at the data and I'm saying, well, again, this green line, the orange line represents your monthly non-farm payrolls, and I know the 75 has been well advertised. The just shy of 60 was well advertised as well. But we have also seen a 320 in there as well. So this 6-month rolling average, again, this just shows that while there has been a slowdown, we are still averaging 175,000 on average taking 6-month averages into account. And again, that is not a bad figure. That is a figure that most people would never have attributed to being easily achievable when unemployment is at 3.6%. So I'm not really buying into this massive scare story about where we are right now. Again, we look at GDP data. Yes, the first quarter was boosted by a lower imports numbers and higher inventory building. So the next 2 quarters may not be quite as good. And we may, and again, that may even stoke these fears even a little bit further. But overall, we are still seeing positive momentum. We look at the inflation data. Yes, again, we are pointing low. And I think the inflation data is probably the biggest concern for me, especially given that a lot of the inflation that we are seeing is being triggered by tariffed goods. Non-tariff goods are actually seeing more of a dip. But the 4 lines that you can see on here, and I apologize, they're not perfectly clear, but I think the biggest concern here for me is that the dark blue line is the CPI number, the lighter blue line is the core CPI number. Now, these are both on target or above target as far as the Fed's concerned. The Fed's target is 2%. So these are both on or above target. But what we have below here is the Fed's preferred measure of inflation. That's the core piece, that's the PCE and core PCE price index. The PCE is 1.5, the core PCE is 1.6, and this has probably seen a greater drop-off than what we've potentially seen in, for example, a core CPI. So I think that's probably a bigger concern from a market's perspective, because this effectively means the Fed is undershooting, which is probably why people are so convinced that we are going to see an interest rate cut. And I think many people would suggest that this is probably the trajectory which we're seeing here doesn't bode well either for the coming months ahead. Do I think the market is overconfident on rate cuts? I do personally. Now that's just my personal view. I should really stress that. I think 3 rate cuts this year would be extraordinary. I don't think the data necessarily warrants it. I think this is having a lot of almost worse fears being factored in. And based on that, I don't personally see that happening. I think 1 rate cut because of the way the inflation data is going, I think that's understandable. I think that's I think that's something that the Fed could be pushed into. I think even up to 2 rate cuts, maybe. I'm not even convinced about that, if I'm perfectly honest. But again, the inflation data doesn't really help the Fed's case. One other issue I have with this is that one of the reasons why I think the Fed's been so reluctant to talk about rate cuts so far, or to fully acknowledge rate cuts, is because the 4th quarter rate hike was a mistake. We were saying that at the time, and I think many people were saying that at the time. The market was in the midst of a 20% decline. Fears over trade with China were very much growing. There was a lot of volatility in the market, and the Fed in December decided to raise interest rates for a 4th time that year. That was a policy mistake, and to cut interest rates too soon would be effectively admitting that mistake. And I think the mistake was driven by this desire to reassert its independence in the face of a Trump administration and a president himself who was constantly who was almost calling out the Fed and Jay Powell on a daily basis. And I think it was almost felt like an act of defiance, and that's what that's what I think drove the policy mistake. I'm not convinced we would have seen that under past Fed administrations, under Yellen or under Bernanke. I don't think we would have seen that response in December. But we are where we are, and I think the Fed is going to be a little bit reluctant to be cutting interest rates 3 times unless things get significantly worse. because it would be the most clear acknowledgement of a policy mistake if we did see that. So to take us back to the actual economic data, then we do have more Chinese data this week, which I think could help to lead the European Open in the markets, and we often see that can be the case. I think the most notable one is the end of the week on Friday, retail sales, industrial production, and fixed asset investment as well. So I think that could be an interesting one. Chinese inflation, again, I think that it's kind of at levels that are seen as broadly tolerable right now, and we're likely to see some form of monetary and fiscal stimulus anyway to continue to support the economy. So perhaps maybe less impactful, especially from a more global perspective. And like I said, the other aspect now is the UK data. This week, and we've had this kind of softer data at the start of the week with the manufacturing and industrial production figures. Again, this was largely driven by lower car manufacturing in April. This was primarily due to planned shutdowns in a number of different car manufacturing factories, Jaguar Land Rover and others, who decided to bring forward annual planned closures to April in order to prepare potentially for a no-deal Brexit. So Brexit Day was the 31st of March, so they decided that if we're going to have a planned closure this year anyway, then it should be in April. What that meant is that because they all did this at the same time, I think it was a 50% drop-off in car production in the month of April, which significantly had a negative impact for manufacturing output and therefore monthly GDP, which we now get which meant that we had a contraction of 0.4%. So that's why there wasn't too much to be concerned about here. I was far more confident and far more buoyed by the jobs report today, to be honest, because we didn't get a drop-off in unemployment, which some were predicting. And average hourly earnings continues to not necessarily be high, but it's at 3.5%. I think that's the envy of many countries, and will continue to, you would imagine, would continue to feed into these higher, these at least at or slightly above target inflation readings for the Bank of England. If that can continue into the end of the year and we can get a smooth Brexit at the end of October, then the Bank of England may have a decision on its hands, because we do have a tight market and we have inflation now, and we have interest rates at only 0.75%. Now, the interesting thing about that for me, which I'll bring up another Reuters icon chart, is that the markets aren't buying that yet. So what that says to me is not that the markets aren't buying the tightness of the labour market or the ability of the economy to bounce back. It says to me that the markets just aren't buying a smooth Brexit, a smooth, orderly Brexit on the 31st of October. You've got a small bit which is factored in of a no-deal Brexit in the case that Boris Johnson, for example, wins the leadership race. The risk of no-deal Brexit raises, but again, even then, I'm not entirely sure how you go about defying Parliament in order to achieve that. But obviously there's a higher risk than there would be with Jeremy Hunt or a couple of other candidates, and certainly Theresa May. Then there's obviously the risk of the harder Brexit. And again, even if we do exit and we get the harder Brexit, then that's seen as being more negative for the pound and more negative for the economy, which of course is more negative for interest rates. So what we have here is a situation whereby the markets don't really don't really know how to perceive this. So what we've got is, through to August 2020, the markets think there's a more than 70% chance that interest rates just don't change. A 0% chance that they raise. That could change if we get a smooth, orderly Brexit on the 31st of October, and I think it will. Or a 25% chance that we actually see one cut in that time. Again, because the amount of uncertainty, because the amount that can change over the course of the next 4 months or so, I think these odds are going to shift dramatically over in that time. And then we've got, because again, we take a look at some of the UK data, and I know we're pushed for time now, so I will push on and move on from this quite quickly. But I think this data really does just highlight why the Bank of England could have a decision to make later on this year. Again, inflation has been dipping from highs of above 3%, but this was in many ways false inflation. This was driven by a big drop off in the pound back in 2016, and the annual impact that did cause in 2017, which means we were running inflation above 3%, which, as you can see here, took its toll heavily on retail sales. Very clear relationship here between real wage growth, which is wage growth minus inflation, and actual consumer spending. It's an obvious relationship, but you can see that it really took its toll there. But unemployment is still at a 44-year low at 3.8%, the lowest since the start of 1975. Earnings are growing comfortably, and retail sales, again, we're seeing decent levels of consumer spending once again. It may be influenced around the kind of Brexit period, and we may see that dip this year. But when we're looking at these figures, and we're looking at growth, for example, which, don't get me wrong, it's not strong growth, 1.4, 1.8%, but these are still decent enough levels of growth that if we do achieve this smooth, orderly Brexit, then we have a platform to work from, which is what I think the Bank of England will be viewing this as. There are other things to keep an eye out for this week, things like US inflation, of course, which is what I've highlighted earlier on, and things like Aussie employment data as well. But we had that rate cut, so I don't think it's going to be too impactful in the near term. And of course, US retail sales on Friday is always a big, an important release, especially again when we're talking about the Fed. But if the jobs report didn't really move the needle on a June meeting, I struggle to see the retail sales data doing instead. Well, hopefully that's bored you all enough on the fundamental side. So we will move on to the charts. And again, this is likely to run over 5 or 10 minutes, so I apologize. But if you do miss anything, you will get access to the recording. It will also be available on YouTube, on Twitter, on MarketPulse. So you will be able to find access to it if you do miss it. So apologies if you do have to log off. But there's just a number of things which I really wanted to cover during that part. And as ever, it has run a little bit over. So looking at the charts now, we're looking at euro dollar here, and there is potential that we've seen a nice move. And I've been saying this for a long time. I'm not overly interested in a move back, a continued slow grind lower. For me, I think what would be far more interesting is a break through the kind of 113s, 113.50s. And we may be seeing that unfold right now. And the reason why I say may is, yes, we've taken out the previous highs, and that's taken us through the 1561.8 fibs here, and technically we've broken above that kind of long-term descending channel, which does give me some hope. The thing that makes me question it potentially is the fact that having broken out, we've immediately pulled back inside. That may just be temporary. We may just be testing support around the kind of 113s, but I'm just not entirely filled with confidence as to how quickly we are seeing a bit of profit taking on this. It may just be that we're waiting for a breakthrough these kind of 114 levels, through the 200, 233-day simple moving average, through these kind of prior levels of resistance before we start to gather any real momentum. So I'm optimistic on this breakout here, but I'm not full of confidence because of what we've seen over the past 24 hours or so, which has maybe indicated that markets aren't as bullish as they may typically be in the event of one of these kind of breakouts. And again, this consolidation that we're seeing here, this failure to make a new high, doesn't really help that situation. So again, this is probably one to monitor for now because the breakout just hasn't been very significant. We look at something like pound versus the US dollar, and this again is potentially looking a little bit more bullish. We have seen a strong sell-off to this point, so a corrective move wouldn't necessarily be out the realms of possibility. The UK data is potentially providing a little bit of a bullish catalyst. Again, though, the thing that makes me question this is that leadership contest. It is the fact that there are a number of hardline Brexiteers in that leadership contest. A front runner by far currently is Boris Johnson, who's very hardline Brexiteer, who seems perfectly comfortable with no deal Brexit, withholding the 39 billion euros that the UK effectively owes to the EU for various projects and pensions, etc., that's been committed to prior to triggering Article 50. This kind of approach may be successful, but it's unlikely to help economically in the meantime. It's no guarantee that it will help achieve a better deal, and it doesn't help avoid the cliff edge of falling back on WTO terms. And it really reinforces the need to get more of these trade deals rolled over, like has been achieved with South Korea, which was announced yesterday. There's still 39 others. I think there's 40 trade deals in total that the EU has struck that would need to be rolled over. South Korea may be a little bit of an easier one to agree on. Others may prove far more difficult. And what you tend to what you hear is that things like Canada, Japan, very much fall into that category. So I think that while technically there is potential that this is starting, this looks like it's potentially bottoming out in the near term, potentially heading for a corrective move. Fundamentally, I can't help but feel there's going to be a lot of nervous sterling traders, which may make any gains a bit of a slow grind. However, looking at this from a purely technical perspective, we've potentially got this kind of slanted inverse head and shoulders here. Neckline potentially coming in around these kind of 128s, which would be interesting given that that is a previously noted level of support and resistance on a number of occasions. We can see here, which could make this level a bit more interesting. But again, I fear even if we do break above, this could be a slow grind higher, because I think there's a lot that could happen over the course of the next month and a bit, which could be inhibitive for the pound. But again, if we do see a break higher, then it's, you've got potential, again, depending on how much you pay attention to these slanted inverse head and shoulders, they're not perfect. You could potentially look at this as being a conservative possible price projection and a more aggressive possible price projection, which would take us into the realms of this kind of 130, 129.50 territory. Again, which is a really interesting level, potentially looking at, again, long-term retracements. The thing that just makes me doubt this is very much what's happening in Westminster right now. And euro sterling very much does reflect that. I think the pound dollar is very much benefiting from the weaker dollar that we've seen recently. I think this euro sterling pair is probably more reflective of people's feeling towards the pound right now, which is one of the things that naturally makes me nervous. One of the things I guess you could say in favor of the pound is that these don't tend to go on forever. These markets don't tend to move in straight lines. And that's kind of what we've seen for a month now, is since the start of May, this has moved in pretty much a straight line from 85 through to 89, through to 89.50. Now, we can see the momentum is starting to slip. The stochastic is making slightly lower highs. The MACD histogram is certainly making lower highs, and the MACD moving averages are plateauing. That doesn't mean we're necessarily going to see a turn lower immediately. We could continue to see rallies, but again, if we continue to see them on lower momentum, it would suggest that we're maybe seeing a bit of profit taken a little bit earlier. It would suggest that we're starting to run into resistance around that kind of 89.50 through 91 area. Again, that's a big area, but when you're looking at something that's been such long-term resistance between 89.50 and 91, I'm not particularly interested in trying to find a specific level. I want to see where this market's running out of steam, and again, I just trying to use all the information at my disposal in order to see that. But I think this nicely does reflect people's net sterling anxiousness at the moment, because people are hardly extremely bullish on the euro at the moment. Australian dollar versus the US dollar. Again, we have seen a nice pullback here in the Aussie dollar. We had a break through this descending channel, and we've really propelled higher from here on in. We've run into some resistance just shy of that 50 fib level, and we are seeing a bit of a corrective move now on the back of that. The difficulty around this kind of 70 through 70, 80, 71, should we just call it, is the fact that we've got the moving averages. We do have prior area of support, which therefore means that this could be a solid area of resistance. And the fact that it basically coincides with the 38.2 through 61.8 fib area could mean there's a lot of resistance appearing here. That doesn't mean we've topped out just yet, although this candle here potentially makes me a little bit nervous, because it is effectively, well, it's not bearish engulfing, but it's it does engulf the previous body of the candle and actually close below the open, which can sometimes be a bit of a worrying signal. However, I don't necessarily think the period of dollar weakness is behind us. So you could use something like this just to keep an eye on price action. If we break below the trend channel, for example, then perhaps that does signal that the corrective move that we've seen in this pair has passed, and that the the dollar move has resumed. The interesting thing with things like Aussie dollar is the kind of correlations we can often see with things like the Canadian dollar, the Kiwi dollar as well, and their relationship to the US dollar. More so with the Kiwi dollar, but the Canadian dollar as well to an extent. So it'll be interesting to see how those charts materialize, and I think I think they're probably showing far stronger signals, to be honest, than this particular chart is. Again, we know the levels which is of interest. I would personally love to see a breakthrough 71. I think that would take us in out of a long-term trend, which could be a very bullish catalyst, could create these much sharper moves. This feels again like euro dollar in that they kind of slow grind lower. Things like dollar CAD potentially seeing much stronger signals though. Again, I've talked about this quite a long time, the fact that we had this slow grind higher, this move that was really just struggling to materialize, but taking its time. And I said, what I would like to see is initially a breakthrough here and then a breakthrough here. Well, we've seen two of these. We've held up around the 200-233 day simple moving average, but momentum is very much with the bears over the course of the last week or week and a half. So even if we saw a bit of a corrective move here, retesting these kind of 133s, we could potentially see this come under further pressure. And I think if this breaks, this is a very long-term trend that we are breaking. So this could be a lovely little bearish signal here. I think this could be a real chart of interest now over the coming weeks, even if we do see a corrective move back into here towards the 33.40, 33.50, 34, sorry. Even if we see a move back into there, then that doesn't really worry me necessarily at this point. That could just be a bit of a corrective move following a very sharp sell-off. The momentum seems to very much remain to the downside for now. So again, that's not making me too nervous either. I think this has the capability to be one of the more interesting charts going forward. Sterling CAD, of course, has seen a lot of downside as well because of the sterling weakness and the moves we've just shown you there in dollar CAD. So we've seen a sharp decline. We broke through 170 with relative ease in the end. We did see some consolidation through 170 and 171 there or thereabouts. When we finally broke there, we've sharply fallen back towards these kind of 168 levels. What makes me a bit nervous now, and it's similar to what I've just explained in euro sterling, and that you can see in a number of other charts as well. This has the potential to now be very overextended because just how sharp a sell-off we've seen. You look at the MACD histogram from the low here in May to the most recent. That's a big low difference, but the MACD histogram isn't really displaying that. We're potentially seeing this flatten off. Same with the stochastic, and we're starting to hit long-term support once again following a long sell-off. So we could be looking at this as a potentially logical area of support. I'm not going to try and highlight the levels because from 166 through 177, 67.50, you can see that we've hit bottoms on many different levels. What I'd say is I'm keeping a very close eye on momentum indicators in this area because it does strike me as being a logical profit-taking zone where people who have been on this move from early doors or even later may look at this as profit-taking territory, which could trigger that kind of corrective move. That doesn't mean we may not see further declines further down. It doesn't even mean that we may not see a breakthrough 166 early, but the early signs I'm getting from the momentum indicators and just the amount of support that we see in this quite a wide 166 through 167.50 area, this strikes me as a real area of interest, one that we're keeping a very close eye on, and where we could potentially start to see some more support creeping in. Kiwi Dollar again is another interesting one. In a similar way, maybe to the Aussie dollar, but actually probably a little bit more so. We had the retracement back here towards the kind of 50 fib level. We fell just shy of that. This is more of a bearish engulfing pattern than the Aussie, which means that in the very near term, this makes me a little bit nervous. Beyond that, I still think there's potential for some upside. I guess we'll very much see how likely that is based on how we trade around these fib levels. So this is the most recent low to the most recent high. I will change the color to make it stand out a bit more. Let's make it bright green. And as you can see, we're in that 5061.8 fib zone already. Now, just because the momentum over the last 48 hours is to the downside, that doesn't mean we won't start to see this things hold up in this 5061.8 fib zone. you see here, momentum is still to the downside, so potentially this could be a deeper retracement. This is one of those occasions where there's been so much downside momentum for so long in this pair. I am going to keep an eye on the 78.6 as well. If this breaks through 61.8 fib, I'm not giving up all hope of a rotation higher, if I'm perfectly honest. It's just about keeping an eye on levels which I wouldn't ordinarily pay too much attention to. But again, we have seen a sharp decline here, so it will be interesting to see how these things materialize, and I do think there is potential scope for some dollar weakness. Again, another chart of a chart of interest in many ways. We haven't got a clearly defined trend yet, but I feel like one is materializing, and therefore it's more one to keep an eye on than it is one that's so clear cut at the moment. Let's start with dollar yen just to avoid changing the order of how we typically do these things. Dollar yen is looking still a bit soft. So while we have seen a return of risk appetite over the course of the last week, basically since the start of last week, it's interesting that we haven't seen a massive shift here, that we haven't seen a massive bounce to the upside in the same way that we saw a shift to the downside when sentiment was softer. I find that really interesting. We've found support around 108. Again, that wasn't a major surprise given how we've traded around those kinds of levels before. It's something that we've highlighted on many previous webinars. The return to the upside, though, has been very slow, which makes me think that momentum is very much still with the bears in this case. I imagine you can probably draw a little almost a channel or something on here. Not perfect, but you can kind of see how we're moving right now. You can kind of see the lack of upside momentum, I guess, that's really been building. For me, of course, 109 looks like a really interesting level of potential resistance here as we approach that level. The fact that that kind of coincides as well with the kind of 38.2 to 50 fib zone may add a little bit of interest to that. If we do break above here and head back towards the kind of 109.75, 110s, I'm not in panic mode. I'm not questioning things too much. I still think that just roughly coincides with around the kind of 50 fib. I still think momentum still looks to me like it's with the bears at this moment in time, and I'm not necessarily convinced we'll even get that far, to be honest. I think this could be a really interesting test around the 109s, but let's see how that progresses. Sterling yen really is struggling to gather any upside momentum at the moment, to be honest. We came up towards the kind of 138.50s, and we seem to be stumbling already. Again, this is one that's been such a strong sell-off. You wonder how much further it can possibly go without seeing something of a correction. And all you have to do is look at the momentum indicators of the low to see how much momentum it was losing towards the bottom of this. The thing that worries me is that this looks like consolidation to me, which is typically bearish following such a sharp sell-off, rather than the start of a corrective move. So that makes me a little bit nervous, if I'm perfectly honest. And you can see the most recent highs we've made have been on slipping momentum. I think there is potential for another run to the downside in this. The question is, how much of a run to the downside are we talking about? Are we talking about a run through to 133s, which I'm not convinced about, if I'm honest, at this point? Or are we looking at a run through to 135.50 and a quick rotation higher? Which, if on lower momentum again, may suggest that it's time for a bit more of a corrective move. Another interesting one, but I'm always a bit wary of being too bearish in this case at the end of such a long trend. Euro yen, again, is probably a bit more interesting because we have seen a bit more of a corrective move, so it looks a little bit more clear cut, but we're also approaching a very interesting area around this kind of 123 through 124. Again, prior area of support since the start of 2019, really. We attempted to break above once already and failed before making new lows. We're approaching this area again. It coincides with fib levels. It coincides with previous support. If we do move higher towards these levels, again, I'm not freaking out. I'm not too nervous. I'm not too worried. It just suggests that there's more of a corrective move that we're seeing materialize. But I think this is an interesting area. What's going to be interesting is how this trades in this area alongside how the pound, the dollar, etc. trades in that area against the yen. It's not overly common that you start to see these all heading off in different directions. Of course, they all are independent in terms of how strong or weak they are, but It's just interesting that they don't tend to run away, in my experience. So if I'm not mistaken, too much into like in a overly unique manner. That's obviously not always the case. Things are always changing, and the domestic situation will always play a big role in this. But I will be very intrigued to see how we trade around these kinds of levels. And if we do break above there, then this kind of 124.50 then starts to look a lot more interesting. Probably another one of these with the yen pair as well, because we've seen such a strong bit of weakness. This corrective move is healthy, but it's just not clear how far it's necessarily going to go, and that may also depend on just how long markets can maintain this positive sentiment which we are seeing right now. And on that very optimistic note, I think we will wrap things up there. We have run a little bit over, but I can see that all of you are actually still on, so I'm very glad that you managed to hang around. I hope that you got everything from this session that you were hoping for, and that you will join us again next week for another webinar. But in the meantime, please do check out the OANDA MarketPulse website. It is where you'll find the recording of this webinar and also all of the other content which myself and colleagues do throw out, and check out all the other content which we're pushing out as well: podcasts, videos, webinars, everything. We're just trying to provide as much as we can that can be as useful as possible. If you have any questions, please don't hesitate to reach out on Twitter. It's Craig_Forex. But until then, and until next time, I wish you all the very best of luck with your trading, and I'll hopefully catch you all again very soon. Thank you.